This is Rick Rule for Rule Investment Media and the Rule Classroom, sponsors of the 2025 Natural Resource Investment Symposium in Boca Raton, Florida, July 7 through 11. We look forward to many of you attending, either live in Boca Raton, joining Grant and I, or via live stream from the comfort and convenience of your own home, should that be preferable. Irrespective of how you attend, a couple things are important to know. One, we will be delivering more programming to you in 4 days than you can absorb in 4 days. And so recordings of the proceedings, the entire proceedings, will be available to you, all the breakout sessions, and you're going to need them. We have big picture thinkers, we have portfolio managers, we have entrepreneurs, we have investment opportunities, we have it all. In fact, we have, in some senses, too much. To that end, I'm interviewing every speaker and every exhibitor at the conference before the conference so that you can prepare yourself to get the most you possibly can out of the 4 days of the conference. Remember, after the conference for 12 months, the recordings will be available, and discussion groups concerning all of the topics at the conference will be yours to join for free at the Rule Classroom. To that end, I have the good pleasure I should say, the dubious pleasure, perhaps, of introducing a friend named Grant Williams. I say the dubious pleasure because most years at my conference, Grant Williams outpolls me as best speaker at my own conference. Grant, first of all, welcome. Thank you for many years of support of my conference and many years of fine friendship and conversation.
Likewise, Rick, it's a great thrill. Yours is the first day that goes in my calendar every year, and I look forward to those days with you and the rest of the faculty there. And it's always a terrific conference.
I listened very recently to a wonderful interview that you did with Adam Taggart, which has been published on YouTube. I listened to a lot of your interviews in the vain hope that someday I can beat you as best speaker at my own conference. Uh,
That day is coming, fast approaching, my friend. Look at the state of me.
and one of the things that's well, we'll get to that, but I think I want to lead off the conversation with a wonderful quote from our mutual friend Robert Friedland, the natural resource billionaire, who also generally outpolls me at best speaker at my own conference. And Robert was commenting on the plethora of changes that confront us, the numerous challenges presented to humankind in general and us as individuals. And he had a wonderful quote from my point of view. It goes like this: the situation is hopeless, but for you, it need not be serious. So I want to talk today about the changes that you see, the big picture changes that you see coming. And I want to talk to you about how individuals can prepare themselves to not merely survive, but to thrive. In every sense, be aware of how things are changing, be aware of the risks. But rather than use the risks as an excuse to curl up in fetal position in the corner, go out and use this circumstance to protect yourself, or better yet, better your own circumstance. Does that work for you?
Yeah, it's perfect. And it's funny. This is about the time of year when I start to think about what I'm going to talk about at the conference. Because if you think about it too soon, the world tends to change around on you, and never more so than now. And you've just about given the outline of the things I want to talk about. So this is perfect. Hopefully, I won't give the whole speech away now. I haven't got it put together yet. But yeah, I think what you're saying there, Rick, is absolutely the crux of what we're all facing right now, and that is this enormous amount of change coming, it's the kind of change that is so big that it's difficult for people to see because we all sit a foot away from our screens, and we're that close to events, and we're that close to the markets, and everything is reflected through prices. And the reality of the changes that we're actually undergoing now, that they're way bigger than prices. These are the kind of changes you get every 100 years. If you listen to Neil Howe and Bill Strauss's fantastic work in the fourth turning. So I think having these conversations and sitting down and talking about the nature of that change, and in terms of things people can do, the first thing to do is not be an alcoholic, right? Just accept that change is here. and accept that we've had a phenomenal 40 years of constant tailwinds in our sails, making the sailing as smooth as it's going to be ever, really, in our lifetimes. And the next part is going to probably be some choppy weather. And just accepting that and understanding that the way you approach this is probably going to have to change, that's the single greatest starting point I think anyone can have. So, hopefully we can talk about some of these changes because they're the kind of changes that none of us, even grey-haired people like you and I, haven't really seen in our adult lifetimes.
I'm flattered that you describe my hair as gray. It seems to me it's more flesh colored for some reason. But at any rate, let's get on to some of those changes before we talk about how to survive them. You talk about turbulence. And by the way, I agree. The period 1982 to 2022 was so benign that even I thrived. The falling nominal and real interest rates, the demographics of the baby boomers becoming gainfully employed, savings and investing, the liberalization of global trade, the specialization that makes everybody richer. Seems to me that at some point in time, like 2022, stuff began to change. But let's hear it from your perspective. What has changed and what is likely to change? What do people need to prepare themselves for that's markedly different than that period 1982 to 2022?
Well, I think what's interesting, change is constant, and so the world has been changing throughout that whole 40-year period, and there are big events through those 40 years. If we start with the '87 crash, and then we look at the fall of the Berlin Wall, and then we look at the dot-com bubble bursting, and then we look at the housing crisis. We've seen these periods that have affected markets significantly, but the world has been changing this whole time. But you get to tipping points where that change reveals itself, perhaps in places that you haven't been paying attention to. And it generally begins as a feeling that things are different. And so for me, that's kind of how this started. And the thing that surprised me was, I've been talking and writing about this change for a number of years now. And yet this year, the beginning of this year, around the turn of the year, I started to feel something that surprised me because I'd been expecting change, but the changes are so big and so broad that it made me feel uncomfortable. I felt unanchored to carry on with this tortured sailing analogy that we're both kind of clinging to. Um, and so, I think if you go back to 2020, post the COVID stimulus, and when inflation really reared its ugly head, that to me was the starting point of this, because this was something that we feared for a long time. There had been a lot of ink spilled about the dangers of inflation, and the more stimulus that was applied, the more interest rates were kept low, artificially low, and the more QE was done. Everybody was worried about inflation. Of course, it never materialized, except in asset prices where that stimulus was directly sent. Once those stimulus checks hit people's doormats and the stimulus went directly into the economy, inflation very quickly became impossible to deny anymore. There was plausible deniability for quite some time, but the numbers were there. And inflation's a really sticky problem, because once it's there, governments tend to get voted out no matter how solid their position is. Because if people can't put food on the table, or pay for their heating and lighting, or pay their rent, then people tend to get upset and vote people out. So once we saw that inflation, it was no longer in asset price. It was no longer in priceless works of art. It was no longer in luxury condos. It was in potatoes and eggs and the kind of things that people need. It's not the stuff they want. And with that with that money still in the system and that threat of inflation hanging over central banks, it basically takes away their ability to do all the things they've been doing for the last 40 years to keep this thing together. As that world's been changing, it's been represented most obviously in this huge buildup of debt that you and I and others have talked about for so long. But because there was nothing holding the central bankers' feet to the fire, they could cut rates, and they could give us negative interest rates, and they could do QE, and they could buy billions of dollars of bonds without a measurable problem on the other side. And that now has changed. So it does crimp their ability in the next overt crisis to use the same tactics that they've used for 40 years that have worked. Let's face it, at face value. So that to me was the start of this change, 2020, when the inflation came back. And now we're starting to see little signs everywhere that various pockets are waking up. The bond market is the most obvious place. We've seen not just US yields start to behave very differently post Liberation Day, for example. Yields are doing things that they're not supposed to do. Yields are supposed to go in one direction, they're going in the other direction, and the direction they're going in is higher. And given the debt and given the level of interest costs that the US government has, particularly, that's an unmanageable problem. It becomes unmanageable very quickly. So the changes are not that the world has changed, but we're perhaps at or near or even past possibly a tipping point where the things that people have been warning about have begun to matter in the real world. And that's a problem for investors because if you just strip all this back to its barest elements and you say the world has functioned the way it's functioned for 40 years, and that has been really good for investors of all kinds. If the world no longer functions that way anymore, the very simple conclusion is the conditions for investors are going to be very different. And if you just start with that simple fact, you realize that you have a lot of thinking to do and a lot of adjustments to make and a lot of probabilities to work out to potentially completely reshape not just your portfolio, but the way you position yourself going forward.
So let's unpack that. This will
Yeah,
take an hour easily.
easily.
The first thing that I want to deal with is that you said it was unmanageable, but we're going to have to manage it.
Yeah, yeah.
What?
Well, actually, let me be a bit more specific then, because you're right. I should have chosen my words more carefully. It's unmanageable within the status quo that we've expected, which is low volatility, very little pain, the ability to, as I say, to jump in at the moment of weakness and get some buoyancy back in risk asset prices. It has to be managed to your point, but that managing the situation now is going to require sacrifice on the other side, whereas it hasn't really before.
I want to bring it to a personal level. I want to help my attendees become more personally resilient. I want to help them thrive as opposed to survive. And part of resilience, I think part of the place that you were going is awareness. So I'd like to start with inflation. Uh, I know from talking to people in my database and at the Rule Classroom that most people's view of inflation, at least Americans' view of inflation, is tied to the CPI, the Consumer Price Index.
Yeah.
If you look at the CPI, you believe that the deterioration of the purchasing power of your dollar, if that's the way you consider inflation, is running about 2.5% a year. I would note, Grant, that the Consumer Price Index, among its various flaws, does not include tax. The government is 35% of the economy. I assure you, if I didn't have to pay the tax, I wouldn't bitch quite so much about the index, but that's not on offer. When I informally look at the basket of goods and services that I consume, when I look at the deterioration of the purchasing power of my savings, it seems to me that the deterioration of the purchasing power of the dollar, the practical part of inflation, is something more akin to 7.5 or 8%. I have two questions for you. Does that seem to you to be an accurate assessment from an American's viewpoint? And is it different for someone like you, a homeless person who is in London and Singapore and Grand Cayman and everywhere at once? In other words, is the individual's perception of inflation, at least the individuals in the circles that you and I travel in, the attendees to our conference, accurate or is it inaccurate?
I think if it is inaccurate, it's on the low side. I think that's the reality here. And the interesting thing about this, Rick, and I think you and I have spoken about this before, this idea that if you're told the CPI is 2.5%, but it doesn't feel like it, let's say it's 4, it's not a big enough difference. You tend to believe what the government is telling you, most people. They say, well, okay, it feels like things are getting more expensive, but CPI is only 2.5, so it's not too bad. If you're being told it's 2.5 and it's 9 or 10, suddenly you not only refuse to believe that anymore, but you start to actively disbelieve what you're being told. And that's a big shift because that changes expectations. We've seen some of the charts of the University of Michigan consumer sentiment and inflation expectations are becoming unmoored. I think that's fair to say. So that idea that you can keep things together by telling people inflation's low, telling people things are okay, and they believe you becomes a real problem. And so I think the other point that we spoke about was that when the Federal Reserve looks at a chart of inflation, it does this because what it is the year-on-year change, and they're trying to cap those peaks at 2%, and they're trying to not let the troughs get too low. They're trying to keep it all in that little range. But of course, for the average consumer, the chart's very different. It's the CPI index, it's the cost of things, and that just goes bottom left to top right, and it keeps going and it keeps going every year as inflation lifts the price level of everyday items. And so there's a line on that chart, a horizontal line for every human being on the planet, above which their life becomes unaffordable. And the idea is that as that line goes bottom left to top right and prices go up, that your wages increase at the same pace or hopefully faster. And that tags your horizontal line up in time so that CPI never gets above the unaffordable stage. And of course, wages are no way keeping up with inflation. And so there are a lot more people that find themselves above that horizontal line where things don't work. And that is the same for everybody. Now, it's the same in London. It's the same in Grand Cayman. It's the same everywhere. Everywhere I go, people are suddenly talking about the price of things and the cost of things and how expensive everything is. And for the people whose disposable income is above their cost of living, what they're seeing is it's just eating away at the amount they're allowed to spend on discretionary stuff or save, God forbid, when that used to be a thing. But if you are on that red line, if you're butting up against that horizontal line, it becomes a big problem very quickly, and people are having to make adjustments. There was some news out today that Klarna, this basically financialized app where people can pay over periods of time, layaway essentially on an app for everything from a cup of coffee to a TV. Their delinquencies have gone through the roof, and of course, this was something that was couched as financial engineering and technological advancement. It's basically subprime payday lending on an app. And we're going to start to see those things feed through. We're going to start to see the evidence that is lying beneath the surface where people are having to make conscious decisions about, do we take our family out to the movies? No, we don't. We're gonna have to get Netflix now and not go to the movies because we can sit and watch a movie at home for $20 a month, or we can spend $100 to take us and the four kids to the movies with popcorn and all that kind of stuff. So once you get into that period where people have to make choices, it starts to shift things very, very quickly because everybody's choice is the same. They're all going to have to spend on food and shelter and heating and light. They're not going to have to spend on discretionaries, and that stuff is going to get cut. So I think your question is a really important one for everyone to understand, to work out where their horizontal line is and try and keep themselves below it in the best way they can.
Let's talk about a different demographic. The people who come to our conference are, mercifully for us, not people who are too concerned about the cost of taking a family of four to the movies and buying popcorn. Rather, savers and investors. One of the implications that I see about the circumstance that you and I have just described is the real yield spread. If you believe that the purchasing power of your currency, if you're a US saver, is at 2.5% a year, the 10-year Treasury at 4.4, 4.5 is not unattractive. A 200 basis point real yield in a riskless security. If you believe, like I believe, that the deterioration of my purchasing power is 7.5 or 8, that would suggest that the value proposition is very different, that you lose 3 or 4% a year compounded over 10 years. That would suggest two things. The bond bull market that we enjoyed in the period 1982 to 2022 is really, truly over, at least in the interim. It would also suggest, and I ask you this as a former trader, a bank-based trader, what are the implications for the disintermediation of the long bond market? For individual investors, for equity markets, for debt markets. I mean, this seems to me like a real change.
Yeah.
Let's imagine, to take the conversation a little further, that you and I are the managers of the Stanford University Endowment. We have $35 billion or something. in an endowment, and our job is to ensure that the institution survives or thrives 20, 25 years from now. 1982, you buy a treasury strip or you buy a treasury, you're in pretty good shape. The interest rates are
Yep.
declining. The income from the bond is sufficient to discharge your obligations to your students and faculty. And by the way, the principal of the endowment is rising. Uh, what are the implications of this negative real yield spread? And do you believe that the negative real yield spread, as I described it, is accurate?
Yeah, I think it's. I mean, we can argue about the numbers, but I think it's accurate to say that the trade that you posited at face value that looks attractive, that's not the real trade. We can argue over what the real yields are, but it's not 2% positive. It's zero or it's negative, and neither of those is good for long-term savings. But it's interesting what we talk about this about the Harvard endowment. What's been interesting to note is that if their simple job was to match liabilities, it would be very, very straightforward, and it would have been very straightforward over a long period of time. But of course, what's happened is they've been sucked into chasing returns. They've been sucked into all kinds of structured products. They've been sucked into all kinds of private credit, private equity, because that's where they could get those extra yields that they needed to kind of stay ahead. And of course, we run into a liquidity problem. So, along with the fact that the bond bull market is over, and if it's over and stays where it is, that's the best case scenario. If it's over and it reverses, which it's starting to do right now in Japan, starting to do right now on the long end of the US curve, it becomes a bigger problem with every basis point it goes in the wrong direction. So again, we come back to this idea, which is a constant, that the world does not function the way you have come to know it does. And that's a real big problem. Let me turn this to you, Rick, because you have enough experience under your belt to have actively been involved in these markets. The last time we saw a bond bear market, the last time we saw rates going in that direction, and all the chaos that unleashed. So give us a kind of a sense of an on the ground perspective of how that felt and what it looked like.
Well, I certainly remember the decade of the 70s.
Yeah,
I was a very young man, and frankly, I was too dumb and too poor to take advantage of a lot of what unfolded around me. But I do remember that coming into the decade of the 70s, the prime rate was something like 5. Exiting the 70s, the prime rate was something like 16. That was not good for holders of long bonds.
right.
It was not good for people who held fixed rate debt instruments or people who were obliged to floating rate instruments. And I say not good laughingly. A lot of folks lost their homes, a lot of folks got destroyed. And if I'm right in my own outlook, the probability of higher long rates has a lot of implications. One, investors of my generation, perhaps rather than yours, who are now seeking to become income investors, need to understand that if they invest in things that traditionally have yielded good incomes, those are very often capital intensive businesses. As an example, a pipeline.
Yeah,
As the interest rate rises, your cost of capital increases. At the same time that higher long yields reduce the capitalized value of your distributions, you get caught in a web. If you think that the circumstance that existed over the last 40 years, which is to say that real interest rates are falling, lowering your cost of capital in capital intensive businesses and increasing the value of your distributions, you're going to make a fairly serious mistake. And
yeah,
I believe that investors of my generation need to focus on real returns rather than dividends, despite the fact that they can spend dividends. Because in the out years, this pinch between a higher cost of capital and a lower capitalized value of distributions is really going to bite people. I saw that happen in the decade of the 70s. I saw something else that people probably need to pay attention to. Maybe not me, I might not live long enough. But when yields peak, precisely what worked stops to work,
Yeah.
which is to say, in 1982, when yields started falling, high quality utilities, an example would be American Waterworks, were yielding 14%. Their cost of capital was falling while the capitalized value of their distributions was increasing. So everything got turned on its head.
Yeah.
And I think the real point of the discussions that you have about the turning is that a lot of things are turning on their heads. And rather than paying attention to what's worked over 40 years, you need to understand, as you described very well, that what has worked ceases to work as well. And you need to pay more attention to what's on offer in markets than
Yeah.
on what you wish was on offer. Your wishes are often constrained about your experience over the last decade, which is very different.
I think, for people listening to this and for people coming to the conference, again, you can be really simplistic about this as a place to start. You have to get more granular after that. But all the things that haven't worked during this period haven't worked for a reason because they don't work in this environment. And so by definition, those are the things that are unloved, underowned, out of favor. And so when you get a regime change like this, where things don't just stop going up, but they pivot the other way and go down, it stands to reason that, to your point, the stuff that was working stops working. Well, guess what? The next thing that's going to happen is the rotation into things that actually do work in that environment, and which by definition haven't worked. So just with that very simplistic analysis, you've got the place to start. Look at the stuff, look at commodities, right? I mean, you and I know we've talked about this for such a long time, and obviously there's a heavy focus on those at the conference, but they haven't worked for all the reasons we've just talked about, because it was easier to make money in so many other places. Commodities are a hard place to make money, both as an entrepreneur, as an investor. But guess what? That changes. When the environment turns 180 degrees, it makes stuff that hasn't worked. It makes stuff that hasn't worked work. It makes stuff that's been cheap expensive. And our mutual friend Jim Grant always says that the trick to this is being right about something, and then letting the market decide that you're right later on. And so you've got this wonderful opportunity to look at a sector that has performed incredibly well in the kind of environment that it feels like we're going into, and nobody owns it, and nobody cares about it, and there's it's starved of capital, it's starved of good fortune for sure, and it's hurt so many investors that people just don't want to look at them. And if you are any kind of value investor, and I know that you look at this stuff assiduously, the first place you look is the stuff that nobody would buy with someone else's money. And that's, we don't have to overcomplicate all this. If it hasn't worked, it's likely to work. If it's worked, it's likely to not work. And if nobody wanted to own it, it probably means that at some point everybody's going to want to own it. And so just by starting there, you get yourself a screen of sectors and stocks that you can go to work on. And that's really what this is all about.
I wonder if it isn't about something even deeper than that. I'm struck by the fact that at the beginning of that wonderful soliloquy, you said that commodities have been a hard place for 40 years, except for they've treated me extraordinarily well.
Yeah,
We're,
yeah.
we're going to have a group of people at the conference called the Living Legends, people who built multi-billion-dollar companies from scratch in a market that was unfriendly. Another thing you said was that you have to look where other people aren't. You're a believer in cycles. In a 40-year down cycle for commodities, individual commodities cycled a lot,
Sure.
40 years. And
But Rick, it's interesting you bring that up, and I don't want to talk over you and interrupt, but I think there's a really important point here for people, and that is the fact that because of passive investing and indexation and people's focus on benchmarks and the S&P index as the place that they're all trying to outperform, you could just buy stocks, okay? And that's worked very, very well. Going back to our earlier point, it might not work so well. In fact, I saw a terrific chart a couple of weeks ago that Ned Faber put up of the longest periods of negative real returns in equities in developed markets between 1900 and 2024. It's 124 years, was the longest continuous period of negative real equity market returns. The world average was 22. 22 years. And Austria had a 96-year period of negative real equity returns. So these are the kind of things. The US, I think, was 16, which I'm guessing was like the mid 60s to the early 80s, somewhere around there. But there are
15,
periods when,
too. I lived it.
yeah, right. But the point being, there are periods where equities don't do anything. And when we talk about commodities, those living legends, they're not just people who are investing in commodities, right? These are unbelievably skilled entrepreneurs who, to your point, have managed, despite everything, to make money in an incredibly difficult environment, in an incredibly difficult sector. Now, if we're right about everything flipping around and all that money that's been hosed everywhere but commodities starts coming into the commodity sector because people say, well, I just need exposure to commodities. Just imagine how those living legends are going to do when they've got an abundance of capital and they don't have to fight and scrape and scrap for every dollar and watch every item on the balance sheet and pay really meticulous attention to everything just in order to survive. I mean, it's a mouth-watering opportunity for some of those guys, I'm sure.
Don't tell them that. It'll mean that I'll have to pay up in these financings, and these
Yeah, right.
bastards won't have to give me warrants. I want to talk about gold a little bit, Grant. People ask me all the time, or not so much now, but they asked me in the early part of this decade, when's gold going to move? And I would scratch my chin sagely and say, I think gold's going to move in the year 2000. It was $253 an ounce. Now it's whatever it is. And so I have a couple questions for you. We talked about the fact that things change. If gold has moved from, in the last 25 years, 12-fold, is there anything left? In other words, is that changing too? And depending on your answer to that first question, what place does gold have in the affluent investor and speculators' portfolios, given the changes that you see going forward? We're going to have a lot of interest about gold at the conference.
Yeah.
You were there last year. You were there the year before. I did everything but call people's brokers for them on the gold trade.
You did. And I seem to remember you actually did call a few of their brokers.
I was the broker. Yes, I called myself and said, you will implement. But go ahead, talk to me about gold and talk to me about whether a 12-fold move in gold is sufficient to accommodate the changes that you see in society and their impacts on individual portfolios.
Yeah, this is a subject very near to dear to my heart, as you know, and I've spoken at your conference for many years now. I always speak about gold in I'm sure an exhaustingly long-winded, roundabout way for most people, but my message has been constant throughout that period. You should own some gold, and how much you own is going to differ for everybody. And last year, I think at the conference, I kind of gave my own personal journey in thinking through why I need to own gold, the reasons why I need to own it, and what has happened since. And I bought my first gold in 2003 at $333 an ounce. And so I just walked through. The reasons I bought it were largely for protection of purchasing power. I looked at what happened post 2000 and realized that this was our way forward. I'd spent time living in Japan and I closely followed Japan, who kind of started QE in the late 90s. And I could see post the dot-com bubble bursting that this was going to be the roadmap. It was going to be low interest rates. It was going to be QE. And the consequence of that was clearly going to be the loss of purchasing power. And that's played out. So until then, I'd never really focused on the gold price. I mean, I paid attention to it now and again, but I'd never owned any gold. I'd never felt I needed to own any gold. I didn't really feel like gold served any kind of purpose that suited my portfolio. That changed when I went through the process of trying to work out, okay, what's the biggest problem I have to face as an investor? What's the thing that I need to most mitigate? And we'll obviously assume everyone understands they have to mitigate risk as best they can. And to me, it was exactly what you talked about there, loss of purchasing power. How do I make sure that the dollars that I earn today at least keep up with inflation and aren't devalued away by the central bank? And gold was the solution to that for me. And so I started buying gold, not because I thought the price was low at $333, but because I thought that whatever happened, that price would reflect a consistent purchasing power over time. There might be periods where it outperforms, there might be a period where it underperforms, but at the time, I was a 33-year-old man, 36-year-old man. And I knew that I needed to protect my purchasing power over the next 20, 30 years. And so I started buying it, and I didn't focus on the price. I just wanted to accumulate gold as I saved. I wanted to hold a significant percentage of those savings in gold for that one reason and one reason only. And I knew that along the way there would be opportunities for me to not sell that gold, but exchange it for something that I felt suited my purposes more. And this idea of having purpose is something I'm going to talk about at the conference. Um, and it's played out exactly that way. The example I gave at the conference last year, one of them anyway, was the median house price in the US, which when I first bought my gold was $200,000, and as of last year, it was $417,000. And of course, all the headlines that you read in the news about the housing market are how houses are unaffordable for young people, and it's impossible to get in the housing ladder, and that's because wages haven't kept up with inflation, and because purchasing power has eroded the value of your dollars. But if you put that $200,000 for the median house price into ounces of gold back in 2003, forget the price, the number of ounces of that gold you would have to exchange today for that house price that's doubled was, I think, 81% fewer. So gold is something that people go to the price first and foremost because that's the representation they see. We can all write a headline about gold breaching 3,000 and next target 3,500. People can recognize that as a target, as an aspiration, but it's really what that gold does for you. And another perfect example of this is the 2008 crash. Of course, when Lehman went under, gold fell, and everybody said, "What the hell's going on? Gold is supposed to be the safe haven asset. Why is gold falling?" And of course, it fell because it was the only liquid asset people had. They had to raise capital, so they sold their gold. What happened was gold bounced very quickly, and even though gold fell, the S&P fell 66%. So the units of the S&P that you could buy with those same gold ounces was, I think, almost just over twice as many. So again, if you can get out of this mindset about the price and get into the idea of what you might exchange that gold for, and if you think that the problem you're going to have to ameliorate is loss of purchasing power, gold is a wonderful tool for that. And the price over time takes care of itself, and you can go back 6,000 years of history and see that it does. It's just, can you get out of the mindset of, if it goes to 5,000, I'm going to sell? Because if gold goes to 5,000 or 10,000 or 20,000 or 30,000, there are people that can make really cogent cases as to why the correct price of gold, given the debt in the world, should be $30,000. My point would be, at $30,000 gold, we got an awful lot more things to worry about than the price of gold. And so you want gold to maintain your purchasing power. You don't want it to go up too far too fast, because that's a sign of immense stress building up in the system. And one more thing I would add, Rick, and that is this last run we've seen up above 3,000, heading towards 3,500. The impetus for that, I think, is very different than what we've seen for a long, long time. And that is the fact that central banks are buying gold, not because they feel like it makes sense for them to own gold in their portfolios or in their reserve mix, but because they feel they have to buy gold now. Because the US, given what they've done with the Russian central bank asset freeze back in 2022, have proven themselves, under certain circumstances, to be a capricious partner, and one that you can't necessarily trust in complete faith all the time. So this bid under gold is driven by central banks who need to own gold. It's not a choice they're making. It's not price dependent. They're not looking at charts and deciding where to step in. They need to diversify their own portfolios. They need to have a bigger allocation to gold, and they don't care what price they pay, because most of them can print the money to buy it anyway. So I think that's a very different setup for the gold price going into the rest of this year.
Again, there's a lot to unpack there. I run an alternative ledger as a sort of a thought exercise, where I look at the various components of my own income statement balance sheet in gold terms. And if you do that, you're struck by how cheap things are.
Yeah,
Now,
exactly
I
right.
will admit, I had more of my savings in fiat currencies than I did gold. So although I keep the ledger in gold, I haven't lived my life in gold. But when I do the ledger in gold terms, I'm struck by the more muted nature of my investment performance, which I
Yeah,
measure in dollars, and I'm also
yeah,
struck by how cheap things are in gold. I would remind the viewers of this video that in the 1970s, according to the Office of Management and Budget, by the way, then headed by David Stockman, who will be a
yeah.
presenter at our conference,
Terrific.
um, uh, the US dollar, in terms of its purchasing power, not relative to other currencies, but in absolute terms, over 10 years fell by 75%. Uh, I don't think it's coincidental that during that same period, the gold price ran 30-fold. This isn't a suggestion that the gold price is going to run 30-fold. But I personally believe that given what I call the math of America, the fact that the IRS suggests that the personal aggregate net worth of Americans is $141 trillion, and our on balance sheet liabilities net of the Fed's own treasury are 30 trillion, and the net present value, according to the Office of Management and Budget, of entitlements is 100 trillion. If you take this 141 trillion in private wealth and you subtract 130 trillion in aggregate government debt, it seems to me like the only way out of this circumstance, the only way you honor the nominal obligations, is to reduce the purchasing power of the dollar, very much like the 1970s. So it seems to me that the performance of the purchasing power of the US dollar in the next 10 years will resemble that of the 1970s. And I think it's important for people to recognize that in some senses, past is prologue. While I don't expect personally the gold price to go up 30-fold, it wouldn't surprise me if the price of gold remained constant in real terms, which would
Yeah.
suggest that the price of gold would be the mirror image of the purchasing power of the US dollar. And because I like to personalize or individualize all of these great economic trends, I'd ask you to comment on that. I'd ask you to punch holes in my thesis about the deteriorating real purchasing power of the US dollar and the efficacy of maintaining some gold holdings, despite the fact that gold is up 12-fold.
I would love to poke holes in it. I find it increasingly difficult to do because of the things that we've just talked about. And you know, the beauty of debasing the purchasing power, and we go back to Nixon's infamous announcement on August the 15th, 1971, when he talked about, your dollar, the dollar in your pocket will not change. Your purchasing power is not going to change. It's just going to hurt the evil speculators. Of course, the dollar didn't change. The dollar was exactly the same, and people got paid exactly the same. It's just the cost of everything went up. And so it's a very effective way. And I think was it Lenin that said that how insidious inflation was that not one man in a million will recognize it. It's an insidious way of doing it because people don't recognize it. They look at their dollars, the dollars look the same. They can't make that link between why it feels like everything's getting more expensive. Of course, it's not getting more expensive. The value of their dollar is being eroded. And there are an awful lot of these kind of these ways of thinking that you need to, as part of this change and as part of understanding that the world has changed, you need to change the way you think about things. And this is one of the key ones, Rick, as you well know. This idea that the gold price is going up. You have to try and find a way mentally to flip that on its head and understand that gold is an inert metal. It does nothing. Gold doesn't change at all. There's a fixed amount of it as it grows very slowly. It's just the value of those dollars. You have to throw more at it to buy yourself an ounce of gold. And so the sooner you can stop thinking in dollar terms and start thinking in asset terms and how many dollars you're having to exchange for those assets, the quicker you can understand how inflation works and why it's such a problem. And we talked earlier on in this conversation about the fact that these problems are manageable, but they're going to require sacrifice. And of course, this is exactly what we're talking about. You are going to sacrifice your ability to buy the things that you're used to being able to buy, even though you've got the same amount of dollars, in order to meet that mathematical conundrum that you just laid out, that the OMB kindly described for us.
This leads so many places, but let's go to sacrifice just for fun, something that most people don't like to talk about.
Right.
I want to talk about two different sacrifices. One is the psychological sacrifice of time preference. I've
Yeah.
graded tens of thousands of portfolios for free, and I've learned a whole bunch of things that people do wrong. Many people strategically get the big picture right. They think in 5 year terms or 7 year terms, but they have trauma holding a position over a long weekend, fear of missing out or something like
Yeah.
that. They fear volatility more than they fear real risk. I suspect that's because people haven't studied their investments enough that they can differentiate between price and value. But could you comment briefly, because I have two more questions to ask you,
Yeah.
about time arbitrage, about the fact that in order to preserve your purchasing power and your wealth, you have to think in 5 or 6 or 7 year terms rather than in the shorter terms that we all, of course, would prefer.
Yeah, I think I spoke earlier about purpose and the importance of having purpose and understanding what your purpose is. And part of that is time preference. If you the presentation I gave last year at the conference, was about investors and speculators and this idea that a lot of people call themselves investors because it kind of sounds cool if you're an investor. It sounds like you're measured and you're considered and you think things through and you allocate capital and you risk manage, you do all those things. But what it also means is, to your point, you have to have a longer time horizon and the courage of your convictions and the ability to withstand drawdowns, assuming you manage the risk appropriately. Um, a lot of people believe themselves to be investors, but they behave like speculators. And if you get that wrong, if your time preference is not allied to your disposition and your purpose, it's just about the surest fire way to lose money. Um, and this idea of time preference when we are in the middle of an enormous change, a big picture change that we've talked about here, has never been more important because we're in a very short-term world and we've seen how everything has been geared towards getting you to trade more, or all the apps will, feed you dopamine all day long if you trade on them. And if we assume that that has worked in this day and age and everything else that's worked is not going to work anymore, that's also one of the things that is going to be reversed. And this idea of being able to find good companies at good valuations that fit your time horizon and meld with your purpose. That's what investing is. And there will be plenty of opportunities to do that, to structure a portfolio that if the problem you're looking to avoid is the next 5 years, how do I get through it? You get through it by getting your portfolio aligned with your purpose and aligned with your time preference.
I want to talk about another sacrifice briefly, and that's the sacrifice of performance for liquidity. Uh, I have maintained a lot of liquidity since I've been able to, for various reasons.
Yep.
It helps me sleep nights and stay calm, which at my age is a wonderful thing. But liquidity costs. If you believe, like I believe, that a deterioration in the purchasing power of your savings is at 8%, and savings products yield 4.5, it means that you're losing 300 basis points a year maintaining liquidity. I believe that's a sacrifice. I believe that the negative real yield is an option premium on having liquidity during periodic liquidity crises like 2008 so that you can take advantage of the situation rather than being taken advantage of. Can
Yep.
you talk a bit about the necessity, if you believe it's a necessity, to sacrifice yield for liquidity?
Look, I think there are periods when it is important, when the risk that you potentially face is the risk of permanent impairment of your capital. If that's a meaningful risk, it's not a risk worth taking. And if you have to give up some performance in terms in return for avoiding that outcome, it makes sense. But this is one of the reasons that I went to gold. I hold my liquidity reserve in gold. That's what it's there for, because I figured that solves that problem. It's completely liquid, but it also will perform over time and maintain my purchasing power. So worst case, I may not get a real yield on it, but over time, I'm not going to be faced with a negative yield on that. So that's how I've thought of gold as a liquidity reserve. And over again, with the time preference that I set back then was 20 to 30 years, And over that time, it's done exactly what I hoped it would and more. It's outperformed significantly. And it gives me daily liquidity if I ever do find something that I want to own more, or that fits my time preference more. But yeah, I think this idea that every day is an opportunity to make money, there are periods of time where that's a really dangerous attitude to have. There are times to play defense. There are times to give up a little. Richard Russell used to say, in a bear market, whoever loses the least wins. And I think that's an interesting way to look at it. And in fact, there's a great story. A guy called George Walton Williams. I'll tell this quickly because I know you've got another question to get to. But a guy in Charleston, South Carolina, who was a gun runner. I've told this story before, so if anyone's heard it, they can fast forward. But he was a gun runner in Charleston before the Civil War broke out, and he was running guns to both sides. But he would only accept payment in gold and silver. He wouldn't accept dollars. He wouldn't accept Confederate dollars. And so he ran guns to both sides, made himself a small fortune in gold and silver. The Civil War erupts. He's a gun runner. Obviously, it's good time to be in business. When the war ended and the Confederacy fell, the Confederate dollar went to zero overnight. And the next morning, George Walton Williams woke up. He was the richest man in Charleston because he only had gold and silver. And he didn't get rich because he made a lot of money. He got rich because everybody got poor. And so he bought all the banks in Charleston. He built the biggest house in the city. It's called the Calhoun Mansion. It's still there today. Um, and in order to alleviate the risk that he saw, and giving up any kind of return, he figured this is the smart way for me to hold my savings. And when everybody else got poor, he stood exactly where he was and became the richest man in town. So again, it's just another way of explaining that you don't have to take risk every day. And when you do take risk, you have to make sure it's appropriate risk and you're not chasing something for the sake of, I've got to make some money here in order to keep up. There are times when it's perfectly acceptable in the short term for the safety you're given to leave a little bit on the table.
At the beginning of that discussion, you mentioned the word hope. I am hoping that this interview causes more people to attend the Natural Resources Investment Symposium in Boca Raton. And I want to close this interview sort of the place we started it. Robert Friedland said, "The situation is hopeless, but it need not be serious." That brings up a different quote, one very recently from Charlie Munger, that said, "You either are going to be," oh no, let me rephrase that. He said, "You can never be an earning machine if you're not a learning machine." My hope is that employing the dictum of Munger allows you to adopt the dictum of Friedland, which is to say, the more you learn, the more personally resilient you are. The more personally resilient and intelligent you are, the greater the chance that you thrive as opposed to merely survive in the 10 years in front of us. I want to tell people who are considering coming to our seminar that unlike any other natural resource investment educational program, or unlike any other investment seminar I know of in the world, ours comes with a solid gold money back guarantee. If for any reason you attend the seminar live or via live stream and you think that we didn't earn the tuition we charged you, we will refund the tuition. Looking at the other investment opportunities that are presented to us around the world, this one is, at least in a financial sense, riskless. Grant, I'd like to thank you for this conversation. I'd like to thank you for the support you've offered our conference over a decade, and I'd like to thank you for our personal friendship. Thank you so much.
Rick, likewise, it's a thrill every year to get invited back, and I would urge anybody watching this, if you haven't been, if you've been, you don't need me to tell you you'll be back. But if you haven't been, it's an extraordinary week, and you will meet everybody you'll want to meet and get the answers to every question you have. So I would encourage all of you to, if you can't make it in person, at least sign up for the virtual pass because it's a terrific event.
Thank you.